Listen, I'm going to give you my top strategy in 2024 to get the bank's money. This strategy will work regardless if you are a brand new business, less than 2 years, if you're not generating any income in your business, or if the business owner credit is bad, aka your personal credit score. Regardless of where you are in your business, you have the potential to get the bank's money. You just lack strategy. See, for you to formulate the perfect strategy, you have to have the information and the knowledge. With that being said, I'm going to break down 3 simple concepts. Number 1, business credit. Number 2, business funding. And number 3, bank credit. Then I'm going to give you the strategy on how you can obtain all 3 concepts regardless of where you are in your business, as I stated before. But before we get into that, I want to say this video is sponsored by ADP. Whenever I'm trying to get financial products for myself, such as a car loan or applying for an apartment, I always say that I am a manager of my company and I always show pay stubs. Although you are the founder and the CEO of your company, you want to set yourself up properly as a W-2 employee so it can be easier for you to get approved for financial products. One of the biggest mistakes I see small business owners make is commingling their personal and their business finances and not paying themselves a fixed salary from their business. In order to pay yourself from your company, you have to have a payroll processing company set up. I use ADP. ADP is the largest payroll provider in the country. It's a one-stop shop. ADP can help you with income verification by creating your own pay stubs, health insurance, retirement plans. They offer workers' comp, HR services, 401k plans. ADP also files your payroll taxes on a quarterly and annual basis. And another benefit of using ADP is they report your payments to the SBFE, which helps you build business credit. Look, click the link in the description to receive 15% off and up to 3 months free of service. And when you sign up with ADP by using the link in the description, also know that you are supporting this channel. Thank you. So now let's unpack what is business credit. Business credit is when you take your brand new business or an established business and we go to other companies and we open up lines of credit with those companies. So which means we're going to properly structure our business. We're going to take our business credit profile and based on our business credit scores, we're going to go to other companies and open up lines of credit with those companies. Let me give you some examples. Granger, Quill, Uline, JJ Gold. We got Office Max, Home Depot, right? It's a plethora of and a multitude of different types of lines of credit we can open up. We have gas cards, we have Dell, we have Home Depot, Office Max. So there's a plenty of net 30 accounts is what I'm saying you can open up lines of credit with. However, what's problematic about business credit? Well, when you only focus on business credit, you've limited yourself. So you're doing yourself not only your business, but you're also doing yourself a disservice. Here's why. Because primarily you're focused on vendor trade lines, supplier trade lines, and trade credit, which means you're primarily focused on your paydebt score, aka your Dun & Brad. Dun & Brad is one of the biggest major business credit bureaus. You have Equifax, Experian, and Dun & Brad. Now, you're probably saying, London, what's problematic about that? Well, let me break it down. When you only focus on your Dun & Brad, when you only focus on vendor and supplier trade lines, you're primarily building up your 80 paydebt score. And lenders and creditors or any financial institution out there, they do not care about your 80 paydebt score. That's what's problematic about building on a tier system. So when you only build on a tier system, you won't get very far. You're very limited because you only can use that line of credit at that particular company. Now let's unpack what is business funding. Business funding when you take your brand new business or an established business, but we're also going to take the business owner credit, put the two together, and then we're going to go to these financial institutions and open up business lines of credit or credit lines. So when you go to any national bank, any regional bank, any community bank, any credit union, we're going to get their financial products. These are called financial trade lines that the bank actually care about. But 95% of business funding is predicated on the business owner credit, aka your personal credit. So in order to get in position, you have to make sure that your personal credit is in position, not only the score, but you're also your personal credit profile, which means the data points. Now, some of the perks and benefits of getting business funding is that you have to show little to no documentations when it comes to your financials, which means you don't have to show P&L statements. You don't have to show any tax returns. You don't have to show any paycheck stubs. For the most part, depending on what products you're getting. If you're getting a business loan, you have to show a paycheck stub. But if you're getting like unsecured business credit cards, which is stated income credit cards, you don't have to show much or to little documentation. So that's the power of getting business funding. Also, these business funding credit cards come with 0% interest for a limited time, 6 months, 12 months, 18 months, 21 months. Also, they don't report on your personal credit, so it's not affecting your debt to credit ratio or your debt to income ratio. Also, these credit cards come with high credit limits. So on the personal side, you may get $5,000, but on the business side, you may get 2 to 3 times higher than that, like $15,000. So that's really important if you're trying to not only start, but to scale and to grow your business. So that's business funding. Now, what is bank credit? Well, bank credit is based off 3 major components. But the first thing it's based off of is your revenue. Right? It's predicated on your revenue. So bank credit, it's all about how do you manage your cash flow. This is why technically you're not in business. Again, this is part of properly structuring your business. You're not in business until you have a business checking account. Why? Because lenders and creditors want to keep track of your payment history and your payment data. They also want to know how well do you manage your cash flow. Do you have positive cash flow or do you have negative cash flow? This is part of building bank credit. So let's break the 3 key components when it comes to building bank credit. All right, so key component number 1 when building bank credit is your bank account and its history. Longevity matters. So how long have you been building this business checking account, right? Have you been with that financial institution for 6 months, 12 months, 18 months, 24 months, 5 years, 10 years? So this is why it's very important that you keep your business checking account open as long as possible, because you're building bank credit. And that's a key component when it comes to building bank credit, longevity on your business checking account. Number 2 is your bank rating number. Your bank rating number tells these lenders, tell these financial institutions about your cash flow, the health of your cash flow. So they rate your bank rating number anywhere between a low 4 and then all the way to a high 5. If you look at the chart that's on the screen right now, low 4 is considered the worst, right? That means you're making anywhere between $1,000 in your business. Now, when you want to go to a higher point where lenders want you to be at, you want to make sure that you have a low 5. That's somewhere making about $10,000 a month, monthly in your business. Now, here's the thing. When it comes to your bank rating number, it's your average amount in your business checking account within the last 3 months. So every quarter when your bank statements come out, that's going to determine what's your bank rating number. So if you average $1,000 in the last 3 months of your business checking account, then if you only have a low 4. Now, if you have a low 5, which means you average about $10,000 when it comes to your bank rating number, that's the number lenders want to see, right? You want to at least have a $10,000 average, which means in the last 3 months, you average $10,000 in your business checking account. Lenders love to see that. So that's the number you want to have or above that, right? If you want to go all the way to a high 5, meaning like $100,000 or more, that's perfectly fine, but 10,000 will suffice. The third key component with building bank credit is the relationship that you have with that financial institution. What type of products or services do you have with them? Do you have a business checking account with them? Do you have a personal checking account with them? Do you have a savings account with them? Do you have a merchant account with them? Do you have a CD with them, right? What products or service do you have with them? Do you have a business auto loan? Do you have an equipment loan with them? So that matters, right? Building that relationship with a bank can take you a long way. It could be the difference between you having a $5,000 credit card all the way up to a $50,000 credit card, because you build that rapport with that financial institution. Then you can go to other banks and build that rapport with other banks too as well to build bank credit. So remember, bank credit is based off your revenue. Lenders only care about 2 things: your willingness to pay them back, which is based off your personal credit profile and your business credit profile. Then your ability to pay them back, which is based off your revenue. Do you have the ability to pay us back, or what's the likelihood you're going to pay us back based off your revenue and based off your credit profile, personal and business? Okay, now that we have these 3 separate concepts, business credit, business funding, and bank credit, what's the strategy? This is where you guys been wanting to hear, right? The strategy. How can we get all three, right? Because you're probably saying, London, I don't have good personal credit score. I can't get business funding. You said 95% of business funding is based off your personal credit score. I don't qualify for that. Or London, you said bank credit, right? Bank credit is based off your revenue. Well, I don't have $10,000 sitting in the bank, so I don't qualify for bank credit, right? You're probably thinking that. But here's what you don't know. I'm going to give you a strategy right now. So make sure you like, make sure you follow, hit that subscribe button. I really appreciate it because I'm about to give you the strategy that no one else has probably gave you or you probably never heard of it. So here it is. Here's the strategy. What you want to do is you want to start with building business credit. Because remember, business credit is not based off your revenue or business credit is not based off your personal credit profile. But London, you said building business credit is very limited. You only can do business at that particular company. Yes, I know I said that. But here's what you don't know. Did you know Sam Club Card is the only bank in the U.S., well, they backed by Synchrony Bank, is the only company in the U.S. that will allow you to get an unsecured business MasterCard, EIN only, where you can spend anywhere that take MasterCard. Are you tracking me? So, which means you can build business credit based off the tier system, add the appropriate trade lines on your business credit profile, then go to Sam Club, get anywhere between $8,000 or $21,000 as a new LLC unsecured business MasterCard. So let's look at what you just did. You just turned your business credit card or a business credit profile because you've only been dealing with business credit. Now you turned that into business funding. Why? Because now you got the bank's money. So we did business credit by building on a tier system. Now we got the bank's money. So that's business funding because remember, funding is money. So now you got business funding. Now what you're going to do? Well, now you can liquidate that business credit card, that Sam Club card, and put that money into your business checking account. Let that sit for 3 months. And now you building bank credit. Did you see what I did? So I went from building business credit to business funding. We got the bank's money. And now we're building bank credit because we're going to liquidate that credit card, let it sit in our business checking account for 3 months to build our bank rating up, to build business credit. Then we could potentially get a loan based off our bank credit. That's how you do all three. So we started with business credit. We didn't need any personal credit. We didn't need any revenue. We just went from business credit to business funding all the way to bank credit. Then we're going to get a loan off our bank credit. Now, yes, you will have the monthly payment on that Sam Club card, but use that same money that you pull off that card to pay the monthly payment down or use cash flow from somewhere else. That's the game. That's the strategy. So no matter where you are in your business, you can get the bank's money is what I'm trying to tell you. No matter where you are, which is critical. So I hope you guys like that. Let me hear in the description if you got any questions or any comments. Please let me know and I'll answer your questions. And I'll see you in this video. Peace out.